Ladies and gentlemen, Greg Michalowski from ForexLive.com. This is a morning Forex technical report where I take a look at technicals that are driving the currency markets as we head into the New York session. Today's date is May 3rd, 2023. So let's get started. Well, today's FOMC rate day. The FOMC is expected to raise rates by 25 basis points to 5.25%. That's the high of a range between 5% and 5.25%. At the last Fed meeting, the dot plot showed that the Fed sees the terminal rate coming in at 5.11. That would be where we're going here today if the Fed were to raise by 25 basis points. Now, the last few days, last week or so, even really the last month, so the regional banks have been come under pressure. We saw First Republic Bank go under over the weekend, taken over by JP Morgan. We're seeing regional banks moved sharply to the downside yesterday. The regional ETF, KRE, fell over 6% in trading just in that one single day. So the question becomes, and what Adam outlined in his FOMC preview, is do we see a dovish hike? But how dovish from the Fed? You can read that article on ForexLive.com. Just query for the FOMC preview, and you'll find that article. So please take a look at that, and outlines Adam's view and our view as far as what the Fed may or may not do going into that rate decision later on today at 2 p.m. ET. We did see the ADP national employment number come out at 296. That was much higher than expectations. Throw some cold water on the idea that the Fed might be given a opportunity to not raise rates out here today or be more dovish in their rate hike. But that number was obviously much stronger than the 148 expected. We have the U.S. jobs report coming in on Friday, which is expected to come in around 145K. Still a lot of balls in the air, folks. We'll see how all things pan out. What we did see is that the interest rates which were lower ahead of the ADP report, moved higher, but have since returned closer to the levels right before the ADP report. The 10-year yield is currently trading down minus 3.2 basis points. The 2-year yield, which fell sharply yesterday, is down only 1 basis point. So a little reprieve there, but still down one basis point on the day. So let's get into some of the technicals. We'll start with the euro versus US dollar. And we've seen the dollar move lower against the euro once again. Yesterday we moved higher with the price moving down toward the low price through here, or the low prices through here, where we had the most recent lows coming in here. The price moved down toward that level. In addition, on that move to the downside, we actually broke through this floor level from last week's trading and from earlier this week, where the price, you can see, created a very noticeable floor level through here. Big moves to the upside off of this floor here. So we went below that level. You think the price was going to continue in that direction from a technical perspective, but it wasn't able to do that. Instead, finding support against these lows and started to rotate back to the upside. We closed near the near converged 100 and 200 hour moving averages. That's the blue and green lines here. Also near the 38.2% retracement of this move to the downside here, and also swing area through here, where we had a number of different swing highs, especially back through here, where we had these highs right here, broke above, use that level as a support, and then rotated back to the downside right through here. We did use this level as support here before moving to the upside, and use this level as resistance before moving to the downside, and doing it again here. Got a little messy through this last week or so, where the market traded above and below the level, but notice in trading yesterday, we did find resistance against the high of that area, pushed to the downside, came to the high, and closed the day. In trading here today, we moved above that level, rotating up toward the most recent high prices here from earlier this week and from last week. I guess that's last Friday's trade, and we moved a little bit above that level, and then rotated back down to the 50% retracement of the move down from this high to this low after the ADP report. But as you can see, it's rebounding back to the upside. So the ADP kind of took the wind out of the sails at the top side, perhaps, for the euro versus US dollar. We're going to need to get above 110.44 level to increase the bullish bias on the downside. Ultimately, if the sellers are going to take more control, guess what? We need to get back below the 100 and 200 hour moving average. It's been doing that a number of different times. The market's been trading in a up and down trading range for quite some time here, but moving back below those two moving averages would increase the bearish bias for that currency pair. That's what we'd have to look for from a technical perspective. Right now, the buyers are back in control or holding more control over the sellers from a technical perspective. Let's take a look at the dollar versus yen. The dollar versus yen is the yen is the strongest of the major currency pairs here today, as it continued its move to the downside after reaching the highest level going back to this day. This is a daily chart I'm looking at right now. March 8th fell just short of that level up through here, but we did get above the 200-day moving average in earlier trading this week, but unable to stay above that level, fell below that level, and we're seeing the follow through selling in the dollar versus yen. That's this green line right here. You can see how the price moved above that 200-day moving average, stayed above it, closed above it, moved to the new high, came back down. By the way, this high price right here, if we go to the 4-hour chart, got within 15 pips of the high price that we saw in March 8th, 2023, and I think that was the highest level going back to this time right here at 2022, December 2022. So key level there, and we did find those sellers against those levels. So I'm going back and forth here, but go back to the hourly chart because I want to show how the price moved down in trading here today, found support against the 100-hour moving average, rising 100-hour moving average, and the 38.2% retracement right through here. But the rebound to the upside could, although it lasted for 4 or 5 hours here, could not see any more additional momentum. We moved back below that level, and that's when we saw the buyers turn the sellers down to the 50% midpoint of the move up from last week's low to this week's high. And that level did stall the fall right here. Also, stall the fall was a swing area between the 135.13 level and 135.36 level. Again, we're going to have to go to the 4-hour chart to show you what that looks like. And if you look at the 4-hour chart and go back in time through here, you can see the swing high, swing high, swing high, break to the upside, swing low, break to the downside, swing high, swing high, swing high. So this area right through here is key from this area right back through here. So pay attention to that, mark that on your charts, and we'll see how that level holds up support. 200-hour moving average moving up toward that area as well. So that increases the level's importance down through here for any sort of further move to the downside. We are trading back to the downside after the ADP spike up here, took the price toward the 38.2% retracement, but it would take a move above the 100-hour moving average in order to increase a bullish bias, to take a move below the 200-hour moving average in the swing area to increase the bearish bias. But the bears are more in control in the short term below the 100-hour moving average now. Let's take a quick look at the sterling versus US dollar, quick because it's kind of really choppy, to be honest with you. What I can say about this currency pair from a technical perspective, if I were to point out some levels, is that yesterday's low price did hold support against the low price that we saw in, I guess that's Thursday's trade last week. So near the 124.34 level, so that increases that level's importance. But we are trading up here. What we can say on the top side here is that this area right through here, where we had, we had swing high, and then we broke above that level and swing low and swing low before breaking lower, and then swing high, swing high. We did break above that level. Price should have gone higher. It sort of randomly peaked right here at some unknown level, and then came down and tried to hold against the 100-hour moving average here for a few hours in the early or the late London session before breaking to the downside in the last hour or so of trading, and the market has been able to stay below that 100-hour moving average. So trading between the 100 and 200-hour moving average, we'll see what those levels do as far as defining risk and limiting risk for traders here today as we head into that FOMC rate decision. So there you have it, a pretty intensive look at some of the technicals that are driving the markets ahead of the FOMC, and also taking a look at some of the fundamentals. My name is Greg Michalowski. Good fortune with your trading today. Bye-bye.